Good morning, good afternoon, good evening, depending on where you are and which part of the world you are. May I extend a very warm welcome to each of you to this very interesting webinar we have today. This webinar that's being promoted, hosted by IBS Intelligence, along with Wolters Kluwer, as you know, which is a specialist firm focusing on finance, risk, and regulation. We have a very interesting topic today. A topic that I would assume is of interest to every banker, particularly the CFOs and people who are responsible for regulatory compliance and reporting, struggling, increasingly with not just the quantity of the reporting, but also making sure that the quality is protected and not diluted. So we do have some very interesting thoughts to be shared today by a very interesting panel, and without holding back, why don't I jump into introducing the panel members for our discussion today. Frederick Roland, we have Fred here joining us from Belgium. He is a director for product management, finance. More importantly, he has an illustrious career where he started with, as part of his career, he was responsible for reporting Basel, and he worked for a bank before he actually moved on to Wolters Kluwer. But more importantly, he comes with experience and a master's in economics, in financial management, and actuarial and financial engineering. And more importantly, he is also a member of the Global Association of Risk Professionals. He's an FRM. Fred, it's a pleasure and a privilege to have you on board today. Thank you.
It's a pleasure to be here. Thank you.
My second panelist, and for anyone in the Middle East, needs no introduction to Ganesh. Ganesh is the CFO of Bank Muscat. Bank Muscat, as we all know, is the largest bank in the Sultanate of Oman, has a very long, illustrious career, more than 24 years in Bank Muscat alone. He is a chartered accountant, he is a cost accountant, and a management accountant. Besides, of course, having certified with a GMP from the Harvard. Ganesh, it's an honor to have you as part of the panel today, and looking forward to a very, very interactive session.
Thank you, Ram, and hello everybody. Good to be here in this panel. Thank you.
And I have Peter. Peter is the program project manager at Wolters Kluwer. The best way to introduce Peter is to say that he started his career, or one of his earliest roles that he started his career with was as an auditor. So he has seen one part of the world of where he has seen what it means to be an auditor. But interestingly, he was responsible for regulatory reporting at a bank as well before he actually joined Wolters Kluwer. So I guess, you can't have a more round representation than that in actually having a 3-in-1 role, Peter, as part of this panel today. So welcome again, and looking forward to a very interactive discussion with you.
Thank you. Happy to be here.
Thanks, Peter. And I am Ram. As you know, I'm a senior partner with Cedar, the parent firm of IBS Intelligence, and looking forward to a very, very interesting next 60 minutes. So before we jump into the discussion, why don't we start with a small poll that sets the tone for the discussion today. Fastest fingers first, and I am launching the poll here. I'm assuming all of you can see the screen. So the question on the table is, what is the biggest roadblock that banks have for building a robust financial consolidation and reporting? Is it the legacy infrastructure and the silo of data? Is it decentralized operations? Is it absence of a dedicated risk compliance team, or is it the complexity of the reporting itself that banks need to adhere to? That is an interesting question, isn't it, Fred?
I think it's definitely an interesting question, and we'll talk about some of those topics today. So for me, what I can say, it's definitely a certain governance. So I think there are a few elements that come up here. So I definitely think, for me, the lack of governance sometimes is definitely one of the items that are need to be taken into account.
Interesting. So I am ending the poll now. So anybody who has not voted, here goes your last 5 seconds. If you voted, then I am closing the poll, and let's see what the results are. And the results are, well, almost half the population has to say that the silo of data and the legacy infrastructure is a real challenge that comes in the way of financial reporting. I'm sure we're going to have a very, very interesting talk around this topic today as we jump into more details. So without much ado, why don't I, request Fred to share some of his thoughts, on some of these areas we talked about. Fred?
Yeah, without further ado, I will quickly start with a small agenda as for today. So today, me and my colleague Peter will talk a little bit about the global challenges we see around financial consolidation, but also about some of the first questions that have been raised. And then afterwards, we have a small conversation together with Ganesh about how this plays out in the Middle East and with his experience. And afterwards, we move on to some of solutions that we see in the market and with our, let's say, with other financial institutions, because obviously, everybody and every financial institution is kind of having the same challenges, let's say. Now, just to start off, let's have a very high level look at what consolidation had brought so far. So if you look at the mergers and acquisition theory that a lot of, let's say, the guidance that is provided there are always two main premises that come back. And premise one is consolidation is good, basically because it helps you to scale and to expand in the markets, and it helps you to diversify your products, right? And the second premise, which is of course important, is that over time you will be able to generate economies of scale and to reduce your costs and increase profitability. Now, if you look at those two premises, I think for the first one, this is a more easy win, of course, and it has been the main driver, of course, expanding markets, expanding products, and that obviously automatically brings in some of the revenue top line. But if you look at the second promise that have been made by economic theorists, so the economies of scale, they are presented as a kind of nice byproduct of a merger and acquisition, and it's basically, you wouldn't, at least from let's say from that theory, you wouldn't have to do much to basically benefit from doing more with less. So let's have a little bit of a look at those economies of scale that have been kind of promised by economic theorists, and what are the main challenges around that. Let's have a look at that. So we focus today a little bit on three main elements, which is operations, infrastructure, so technology, and the regulation side of things. Sorry for that. So what are actually most organizations ending up with nowadays when they do consolidation? So like I said, it's really a key element to have operational efficiency, and that's very attractive on paper. But in practice, of course, it's much more difficult to execute. In reality, activities are quite fragmented. So basically you have a patchwork of systems and processes across the business and the regions. And obviously that's not only the fault of mergers and acquisitions, as I just described before, but also, like a lot of people mentioned already, legacy systems built on legacy systems built on legacy systems. Bringing together a financial statement in a matter of days, sometimes weeks, and it takes a lot of effort, right? So it takes a lot of resources, data, processes, and in turn, which basically everything that you spend time on this process, you cannot spend on more strategic initiatives, more important elements, like, for example, budgeting, scenario analysis. So let's have a look at something more in particular, which is also part of that legacy system, is the number of frameworks and repositories that hold data. What you still quite often see is that there are a lot of data disputes between certain divisions. So for example, the finance division, which is using their own data sets, versus the risk division. The original data is normally quite often the same, but on top of that, we have different aggregations coming, we have filtering, we have several calculations, and that sometimes makes the data quite irreconcilable. And you probably heard about buzzwords like data lakes, data vaults, data warehouses. But just to give you an idea about big data, for example, big data is not going to resolve your issues that you currently have with your governance or with your finance, risk, and regulatory stream. It's very focused on data analysis, so for immediate consumption, but it's not a really rigid, coherent process. So concepts like data lakes, data vaults have been around for a while, and you might be working with them or be part of a project or program, but without real ownership and without real governance, the data lake quickly turns into what we call a data swamp, or the data vault into a data vault. So what you get in return is just by consolidating data, that doesn't mean that you can take ownership of it. And that a lot of financial institutions start to wing things by adding even more processes, more reconciliation, more balances, and it becomes an even more complex web to unravel. Now let's have a look at a very simple example that I just want to use as a reference. We have a simple group here, a group with 4 entities in it. So we have 2 parental entities, parent 1 and parent 2. And parent 2 has also a direct investment in child 1 and child 2. So what does that mean in a very simple setup? So as you can see, let's imagine that each of those entities or groups have to report, so both on a solo and a group level. That would mean that you have 6 reporting lines. So far, no sweat, because that's already something that is being done today, but that also is something that you can kind of control, I would say. Now, let's imagine the following, that you also not only have to report on a consolidated level, of course, for your financial statements, but you also have to do that for risk, of course. You probably heard about prudential consolidation. My colleague Peter will talk a little bit about that later as well. But that is already a slightly different way as the consolidated consolidation you would use for under IFRS, for example. You also probably will have to do management and internal consolidation reporting. And that also might be slightly different approach might be chosen because of cost accounting, for example, that you want to apply different methodologies. And the same thing for a local GAAP, you might have to deal with local GAAP or local regulations, which adds to another dimension. Now, let's assume for now that the data on each of those reporting lines is more or less the same. So this adds up to 21 different possible points of consolidation that you would need to do. If we continue with that and we basically look at reconciliation then, because reconciliation is a very important part of your consolidation process. So we have the vertical reconciliation where you basically have to look at intercompany transactions or transactions between the organization. And there you end up basically for each dimension also with 10 different potential pairs, right? And on a horizontal level, you also would get the similar kind of transaction where basically you could potentially end up with different reconciliation that you need to do between those reports. Think, for example, about pillar 3, where they state what's the difference between your results on for financial consolidation versus risk consolidation, and can you explain those differences? So that potentially, obviously that will not ever happen in reality, but that potentially can end up with 210 different reconciliation points. That's a lot, right? To make matters worse, so far we assumed that data was under control and we use one single source, but if data is decompartmentalized and there are different divisions using different data sources, then obviously this increases even more the complexity. But I'm not done. I hope to be done, but you also have to take into account change. So a lot of things can happen. Let's say that our simple group structure moves from a simple group structure where we basically deconsolidate an entity C2, for example, and a period later we acquire a new entity, which we call grandchild entity one, which is part of another on the child entity one. So the whole structure changes. It's not a very difficult structure, but it changes, but it also changes all of the dimensions that come afterwards. So also there, change is a very important element to take into consideration. That being said, I give now the word to Peter, who will talk a little bit more about that other challenge, which is the regulatory part of consolidation. Peter, over to you.
Thank you, Frederick, for this introduction. So first of all, I want to talk about the Basel IV, the regulatory complexity. But first, a small intro. So Basel started all with capital focused, but with the crisis in 2008, there were liquidity requirements added with the liquidity ratio and the leverage ratio. Basel IV now has been delayed from 2022 to 2023 due to COVID. Basel IV should be safer, more risk sensitive, better adapted, but this is of course raising the bar, not only for your consolidation, but also for your Basel calculations. You need more details, more complexity, higher requirements, better lineage, better integrated stress testing, and being faster to meet regulatory deadlines. You can see, actually, you see it already on the slide, Basel is seen as an iceberg. What you see on the top of the iceberg is that what everybody sees. This is the Pillar 1 disclosures with the regulatory calculations and the regulatory reporting. But also Pillar 2 and Pillar 3 disclosures. This is, I would say, the tip of the iceberg. But in practice, when you are implementing and running these calculations, you see that other calculation requirements around capital and liquidity, such as TLAC, the total loss of absorbing capacity, are arising, and you don't do this in a separate system, or you don't want to do this separately. You are led into a requirement of integrated calculations, regulatory calculations. For the Pillar 2, with the key metrics, projection, stress testing, and the capital planning, there are banks that also want to do ALM. And to address this ALM, and this is another aspect of integration, it's the integrated scenarios and projections. If you look further on the regulatory reporting of the Pillar 1, there is a big consistency requirement with Pillar 3 disclosures. Pillar 3 disclosures must be consistent with the other financial reporting and all regulatory reporting. This leads to the integration of all regulatory reporting requirements. And then finally, you think you're finished, but no. And then finally, you need to do this all for all your entities, as well described by Frederick, and also on all levels, and also on the level of the consolidation. So having the consistently data across the group is another aspect, and the data consolidated, which we call integrated consolidations. Next, please. Now I will talk about the Basel IV group requirements. What do we need as a group to start Basel calculations? For each entity, we need data consistency on its own. A reconciliation by design between prudential and financial data. So you could have a difference between your financial and your prudential consolidation. So one single point and one single version of the truth. Because we have main challenges as a group, the data quality on correctness, consistency, and accuracy. And also, it's important the time to view the group. So it's important that you are as quick for the consolidation as your input for your Basel calculation. How can you reach this? Is by sharing the same solution across the group, as I mentioned by Frederick. The same vocabulary and the same platform versus interfacing and reconciliation. Instead of reconciliation, you do data validation. So no data quality is lost in translation. This is the only way, the only real way to reduce the Basel IV total cost of ownership. And then last but not least, the automation of the group consolidation process. So integrating your prudential consolidation into your financial consolidation and monitoring the integrated workflow for your each entity is very important. Because of the multiple and the complex consolidations, you will need more volume. You will have bigger volumes, and you will have to work on your performance, and scalability is key. This is for me. Now I give the floor back for Ram, and I will get back with the use case later on in the presentation.
Thank you, Peter. Thank you. That was quite interesting. So, I guess the point you're making is that the total cost of compliance and reporting is influenced by more factors than one. Well, I mean, on that note, we do have a second poll that may be quite interesting for us to ask, considering that so much time is being consumed by everybody in reporting. Let's ask the audience, which of the following, in your case, tends to consume most of the reporting? Is it the internal financial reporting? Is it the regular returns and the compliance reports? Is it external reporting for investors and stock exchanges, or is it the Basel III and IV reporting that is increasingly becoming a key focus area? Now, as we are having the results coming there, I also want to mention that if you have any questions that you want to ask the panelists, please feel free to use the Q&A tab, which you can post the questions, and I would be happy to have them directed to the respective panelists. Okay, so we have the poll completed. So I'm closing the poll. In case you have not voted, please do so now. Okay, so what's the answer? 43% of our audience believe that the returns and the regulatory compliance reports consume most of the reporting, and that's followed by external and Basel III. Quite interesting. Isn't it, Ganesh? I guess as a CFO of a bank, I'm sure you could relate to this more than everybody else.
That's true, Ram. In fact, when the poll came up, I also selected the regulatory piece based on our experiences. So that takes up quite a lot of time, in the same proportion of 40 to 50%, I would say.
If you were to actually, maybe Ganesh, and if I can turn to you and say, what would be the key challenges that you believe banks face, be it when it comes to financial or regulatory reporting?
Sure, thanks, Ram. See, in terms of challenges, financial regulatory reporting, if you see, it's been there ever since banks have been operating. Quite a vital, essential piece of any bank. So a lot of automation has been done in this areas over a period of time. Banks have mastered the way it has to be managed internally. But still, there are a number of key challenges persist in this space. In terms of challenges, if I have to put it 3 or 4 perspectives. One is the data consolidation perspective. And second is more from a multi-system complexity within the banks. I would explain each one of them later. Third is the reporting, regulatory reporting, and other reporting requirement changing over a period of time. And fourth is more from the complexity and the components within the reporting itself. So these are the broad 4 topics. I'll try to keep it short and go over each one of them very fast. Data consolidation. Traditionally, the reportings have been more based on general ledger data. Over a period of time, the earlier Frederick talked about, even Peter talked about a Basel requirement. IFRS 9 is another large piece. So over a period of time, the data requirement has moved away from core GL, which is given as granted, to customer level data, contract level data, transaction level data. So when an entity or a bank has just not one entity, multiple entities with much higher volume of data in these spectrums, the entire process becomes very complex. That is something taking a lot of time for banks to manage the situation. Second is the multiple business system. Traditionally, probably one core banking would take care of most of the business needs, largely, let's say, retail and corporate some extent. But over a period of time, I'm sure based on CEDAR experience, you would have seen banks have moved into number of specialized systems.
Correct.
Core banking gives only a certain level of information and data. Even some banks have general ledger is outside the core banking in another platform.
Right.
So as a result, for example, treasury system may be a specialized system. Investment banking, trade finance, credit card business, even the expense part would be in an ERP system. So when we have a disintegrated systems holding vital information, financial reporting or regulatory reporting requires everything has to be consolidated. That becomes much more challenging and time-consuming aspect. Third is the reporting requirement is changing over a period of time. The standard packs, both internal and external, are pretty okay, well set process. But over a period of time, there are very, very ad hoc requirements coming up. New reporting requirements coming up. We'll talk about it probably later in another form. And as well as particularly in the last 2-3 quarters, given the pandemic and the challenges the banks are going through, there are very on-demand, detailed data requirement coming from regulators. And these are very, very urgent, and immediately it needs to be provided, and even for internal consumptions. So that poses another challenge. The last piece is the components within the reporting itself. It's again not one single piece of information or data, multiple data. Apart from the data, there are processed reports from other sources. Just to give you a flavor, a financial statement, if you take balance sheet P&L, maybe a traditional way, it easily comes out of GL. But when you come into IFRS 9 disclosure in the financial statement or part of a regulatory submission, the entire IFRS 9 process is outside in another system. It may be a strategic solution or a tactical solution. All those data need to be embedded into financial reporting. Similarly, assets liability management, ALM perspective, there are quite a lot of data which also requires in financial reporting and regulatory reporting. That stays away in another system. A third would be more of a risk management, market risk related information. So when you have even processed information in a disintegrated systems, it becomes much more complex. I think these are some of the challenges what we practically face.
Like a full basket of kind of issues to address in the way you need to. But you actually made an interesting remark, Ganesh, about changing profile of requirements. Especially even during COVID days. So if I was to ask you from a Middle East context, considering that there is obviously a regional perspective we need to look at this, what would you pick as the kind of reporting or the nature of reporting, and how would they vary in terms of their complexity and their criticality?
Sure, Ram. See, but traditionally the reportings we can broadly put into 3 buckets, which applies to Middle East as well. Internal reporting, external reporting, and regulatory reporting. I'll keep the regulatory away from external for valid reasons. So internal reporting largely to the management and the board, which has a spectrum of requirements, etc. which traditionally been more profitability, P&L growth, etc. But it has moved away from there into much more deeper, much deeper sense to look at customer profitability, look at product profitability, look at geographical segmentation, and even look at transaction level profitability. So that is one dimension, multiple dimensions people are looking at it, particularly in Middle Eastern banks. It's a growing requirement. From a regulatory perspective, or external, probably I'll talk about external reporting before regulatory. External reporting perspective, it is for investors, stock exchanges, and the rating agencies, let's put it. These are financial statements, as well as certain other information like Pillar 3 we talked about earlier when Peter commented on Basel 3 and Basel 4, and much more requirement emerging from various other requirements, particularly rating agencies in the recent period. So these are very specific to regional aspect as well, apart from what we see elsewhere. And the third piece is the regulatory piece, where there are on-site supervision as well as off-site supervision specific to Middle East, which may not be there in rest of the world or probably in the European markets. So when you have an on-site examination or supervision, particularly a bank like Bank Muscat, we are a DC bank, it goes over a period of 3 to 6 months, much deep analysis of data and information. So that becomes a key challenge. Similarly, there are off-site supervision requirements which are ongoing, starting from daily to all the way up to an annual submission. So these are some of the perspective from the Middle East reporting. And in top of it, IASB required information as well as Basel related information gets added to the whole basket of reporting.
Sounds like a handful, isn't it? So,
yes.
I mean, would consolidation really make an impact in your view?
I think consolidation, yes, definitely that's the only way out. If you have to constantly improve, reduce cost of compliance, reduce even the total cost of ownership, as well as reduce or have more reliability in terms of what our output comes out. In order to have that level of sophistication in consolidation, again, I would probably talk about 2 or 3 pieces which are essential. It may be easy to frame it in 1 or 2 sentences, but to achieve or reach that stage, it's not easy at all. The data consolidation. And here I probably put it together along with the integrated or disintegrated systems people operate, as well as the level of data is required. If you have to take the entire customer transaction data, huge volume of data in a particular system, let's say core banking, then if you have to look at treasury transaction. So those become vital to ensure consolidation of financial reporting. Number 2 would be more from synchronizing this data and data fields. A customer profile or customer master in core banking could be different from a treasury system. How do you interconnect all this? Make sure that the data consolidation eventually helps the financial reporting consolidation. And the third piece is more to do with bank specific. In our case, I can share an example of over a period of time, we created an ETL type of an setup infrastructure, wherein any system, all the existing systems data have been captured in different set of details. Any new system we implement, as part of the project itself, the data from that particular system from day 1 should come into ETL, so that the financial consolidation process is not hampered at all. We don't depend on another business specific system to derive data. So we ensure that everything comes into a ETL data mart. That helps us in reporting both from regulatory and financial perspective.
So, I mean, Ganesh, in conclusion, if I can ask you, what would you, there's a lot of members in the audience who are fellow bankers and would be watching what you have to say. If I was to ask you, what would the top 2 priorities that you believe banks, there could be a lot of them, but if you had to pick 2, what would you pick?
I think probably I would again emphasize on data consolidation, which is the input is going to make a difference. If garbage in, garbage out, correct? The way we consolidated data and have infrastructure ready to, where no bank is going back to having one banking system to take care of all the requirements. All banks will be operating with multiple systems. That's given. There is no consolidation of banking system comes into play. As a result, data consolidation is key. That's from my perspective. Second is to have an effective, powerful reporting tool, which is user-friendly, as well as able to integrate all this consolidated data to provide, to take care of all the financial regulatory reporting. To add to that, we also talk about it should not be the team in finance should be able to directly handle developments, etc. We've seen multiple systems, still lacks that sort of a user friendliness. You may end up going back to technology team to create, but with the speed in which the information is being asked, I think the capabilities for finance team to internally develop rather than tech support is something would be key in a reporting tool, Ram.
I can't agree more. I think that's the very theme of today's discussion. I'm so glad you said what you just explained. Thank you again for very insightful perspectives that you shared. Maybe before I go back to Fred for you to share some use cases and some experiences, maybe time for us to take a small quick poll with our audience. Next question. So let me go to poll number 3 of the day. And this is kind of going back to what Ganesh explained. So which is the most resource intensive activity in financial consolidation? Is it data collection and quality monitoring? Is it reconciliation across companies? Is it the change in the reporting requirements? And of course, there is a whole host of business structure changes. Is it about managing that, right? So, and I'm sure there are perspectives coming depending on which part of the organization and what the kind of challenge you are facing in there. While the poll is on, may I again make a representation for anyone who wants to ask questions. We do have a Q&A section that follows the next session, which will be focusing on use cases. So we do have some time for Q&A. So if you have to ask any questions, please feel free to post them here. So with that, let me conclude this poll and let's see what the results are. Lo and behold, there is no surprise there. The biggest challenge is indeed in collecting the data and monitoring its quality. So that's a real overwhelming 58% in there. So with that, I would hand over to you again, Fred, if you can take us through some experiences and also on the challenges here. Over to you.
Yeah, so far little surprises in the poll. So it's indeed one of the main challenges, let's say data. But let's move also a little bit back because now we want to present some use cases and some lessons learned that we have seen with several financial institutions when we look at those main challenges, right? So we have the infrastructure, the regulation, and the operations side of things. So given that a few rules of thumb, whatever you do, if you start a kind of revamp of your infrastructure, you have to accept that things cannot change overnight. You probably unlikely have to make some considerable investments. And you will need to prepare for change. Change in the economy, as we see now, in the regulation, but also in your organizational circles. What you often see is that you deliver a certain project or a product, but you only cater for the business as usual and not for the changes that come afterwards. So it's important to establish a very clear vision of what you want to achieve with any program or project that you would start up, and also put aspirational goals, but also achievable goals that can be measured and can be followed up. But I don't want to stay too theoretical, but let's move to 2 use cases. And these are actually real visions of some financial transformation programs that we have with 2 customers of us. I will let you read most of it yourself, but I just highlighted some keywords here. And I think it's important that those words always come back in every kind of use case. And as already mentioned by Ganesh, as well as in the poll, it's all about data first. You see systems, reporting, processing, steering, and control. So this is a snapshot of those key words that you will see in a financial transformation program. Now, if you look at another example, you see similar things. Again, systems, processing, reporting, data. But here there's one small difference, a small nuance, but I think it's an important one. It also says something like in the 4th bullet, implement forecasts to periodically update assumptions. So they cater for change. I think that's a very key one. Always when you start up such a program, make sure that you take into account that you have to deal with change at a certain point in time. Okay, so some of the lessons learned that I can share with you from some of the financial institutions that we work with. So let's start with the main one, as discussed today, data. So I think one of the issues is that when we start such a process of loading data and basically consolidating data in a data warehouse, a data lake, it's often seen as a goal in itself. But be very careful of this, because without clear ownership, and what I mean with ownership, I mean ownership of the data, responsibility setting for that data, it's probably likely doomed to fail. Only when you have people assigned to not only monitor that data, but also own that data, you basically can manage that. And then you will be able to basically roll out a data consolidation program or data lake or data warehouse, which will be successful. If we look at processes, and it's also mentioned already by Ganesh, yeah, we need good solutions, we need good people, but I think it's also very important to be introspective and look at some of those processes that currently run within your organization. Questions like, is this process efficient? Is it optimal? Is it even necessary? Who is responsible for it? And more importantly, can we control it? Is it auditable? Because if it's not auditable, if we cannot control it, it shouldn't be there in the first place. So can we move to something more lean and consolidate some of that stuff? I think that's also relevant questions that you need to ask in your transformation project. What is important is that you cannot boil the ocean, of course. You cannot do everything at once, but you need to have a very high level understanding of what your business strategically wants to achieve, and support that with really bottom-up detailed use cases. Now, again, systems also an important part of the organization landscape. So what you often see is when you go into an organization, a financial institution, and you go to the business process engineers, or you go to the IT department, you often see a very huge picture of the IT landscape on the wall. So when I see such a picture, I always think, very good, very great. We have the first steps already taken. We know how many systems run. We know how it all integrates. But what we often don't see is what would be an ideal landscape. And for example, the assessment of each of those individual systems of their fit for purpose, basically. Are all of the systems efficient and effective? So for example, one of the simple tests you can do is, what happens if I switch off this system? What other system can take over for that? Maybe we didn't look at some systems that can take over some of those responsibilities. And what would that mean? Maybe you have to put in new SLAs, maybe you have to put other metrics, and maybe you have to make somebody responsible to take ownership of that. The last point I wanted to discuss is here with regards to change. And obviously, as we all know, there's only one permanency, and that is change. And how do you prepare for that? I think it's very important, again, what does change mean for you? Because it doesn't mean exactly the same for every financial institution, right? Economy is one of obviously the same for everybody. But if you look at your organizational structure, are you busy with expanding globally? Are you busy with expanding a lot of new product lines? For example, you're introducing structured products, for example. Does your organizational structure often change? And one common advice that I have is like every time a new change occurs and it happens for the first time, make sure that it's part of your BAU afterwards. Establish guidelines, make sure that all of those processes can be rehearsed next time. Also, when you start a process, don't only focus on the BAU deliverables, don't focus on what we have now, but also expect things to be changed. And an example of Ganesh was about IFRS 9. You know, before IFRS 9, we lived in an optimized model way of thinking. And now we're thinking we basically dropped all of the models and we're now thinking about how can we basically provide information to the regulators and provide information where we make adjustments, because everybody does it. We make adjustments, we make management adjustments on top of those models because those models cannot cater for it. But we want to have governance, so we can go to our auditors, we can go to the regulators and say, these are the decisions we have made. This is the delta between the model before and now, and that's what's important. So again, change is very important here. Again, so we talked about all these different reporting dimensions. We talked about the 21 potential complexities that you could have. And how do we translate that to a format that is representable for everyone? Now here is a very impressive slide, and basically it describes a bit of all of the things we have talked to, but I will try to summarize for you in a few elements about what you need to cater for. So you need to be able to set up and change hierarchies quite easily because of change. You need to be able to validate your work and have clear status management on every level. You need to be able to cater for periodical changes in the configuration, for example. You need to be able to align your chart of accounts and with your consolidation chart of accounts, just to make sure that all of those single entities also report in a similar and harmonized way. You need to have control. You need to be able to set limits. You may need to be able to set reconciliation points. And you need to be able to cater for change. And again, let's say in this case, context, life cycle events in consolidation, think of new acquisitions, mergers, disposals of groups of assets or business activities, ownership changes, buying and selling shares within the group, deconsolidation. That all has an impact not only on your financial statements, but also on, for example, Basel, internal reporting, cost accounting, and so forth and so further. And then probably the most important, you also need to be able to consume that data in the format that you want to, because every use case is different. Financial statements is something totally different than reg reporting, as well as internal management. So in sum, you need to be able to roll that out as X number of times over different reporting dimensions and reporting lines, and preferably always on the same databases. The key point, having that same data unified. And for this, of course, there exists expertise, there exist solutions. Again, you can reach out to me or my colleague as well, Peter. But now, in the interest of time, I will pass the word to Peter, who will talk a little bit more about consolidations in Basel IV.
Thank you, Frederick. Yes, indeed. The previous slide showed already the complexity in the system itself when changes arrive. But now we're looking at the structure, a simple example, for example, to show you 5 entities in 3 different countries, no branches, no business line consolidation. So private banking is not split because sometimes you have separate regulatory reporting for your private banking group. This is not the case. We even do not look or do not touch this. And then you have no securitization, but you see there we have 5 entities in 3 different countries. a basic consolidation example. Next slide, please. So you have individual entities, then we have the proportionality assessment. Sorry. So you have so you have multi-level consolidation, country consolidation, sub and group consolidation, excuse me. Depending on the size and the proportionality assessment, you will have multiple consolidations. So you see the size, which is important. For example, here in our example, we have 5 entities in just 3 countries. This would result in 8 Basel IV units. So you have to calculate, this is an increase with 60%, including 3 prudential consolidations, not speaking about the financial consolidation. So this means this shows also in a slight, small, easy example, what is the impact of this increase. Next slide, please. But it does not stop with only Basel calculations, as you can see in this slide. You have the individual country consolidation. You have also local, in the local consolidation of financial accounting, local legislation you have to follow. So for each, you will have regulatory obligation, for example, the proportionality assessment, all Basel IV components and calculations, Basel reporting, other disclosures. But for many of them, you would like to do also the risk management, IRBB and liquidity, ALM, as mentioned by Ganesh, on the same data. That would be ideal. Stress testing, internal versus regulatory measures, ICAP, ILAP, and for the main ones, for your consolidated ones, you would do the budgeting and planning and forecasting, even with scenarios on top of that, and with respect of the regulatory requirements and respect of the internal requirements in the governance. This explains the importance of the link between consolidation and Basel or regulatory complexity as a requirement. And with that, I would give back the floor to Ram. Thank you for your attention.
Thank you, Peter. That was quite interesting. So it's about perspectives with which you're looking at the whole regulatory reporting there. And before we jump into a few questions that we have from our audience, I'll probably run our 4th and the most interesting poll, if I may. And there you go. So the question really is, what would you rate as the biggest challenge to reporting? Is it the quality of reporting as in the accuracy? Is it the compliance with deadlines, which is the timeliness? Is it the comprehensiveness about it or the completeness in coverage? Or is it really about coordinating it from different sources? So maybe as we have this poll on and we also have some questions coming in, and before I jump to the questions from the audience, I do have, maybe a question for you, Ganesh, and this is, in your experience, where do you see the data ownership sitting? Is it with finance? Is it with compliance? Is it with IT? Where do you see the ownership for data in this case, in your view?
Sure, Ram. See, maybe I can share our own experience. Since we extensively talked about data consolidation, multiple system situation. So currently, in our case, it resides with IT in terms of more from a technology perspective, but the quality of data, integrity of data is with finance. So we need to provide a sign off on the accuracy of data on whatever frequency daily. We have a process by the finance team to validate, and that data gets used across the organization.
The joint ownership in a way.
Yeah, the data pooling happens within IT, but the quality and integrity is checked by us.
Interesting. So we end the poll here, and I'm just sharing the results for everyone. As you saw, the coordination and getting data collected is no surprises there in terms of what is rated as issue number 1, followed by the completeness and obviously the quality, which you alluded to as being the conscience keeper is the role that we have to play to make sure that the accuracy is. So, I mean, I'll now jump into some questions with the audience I've been asking. And if I can maybe start with the first question, can someone talk to us about the role of artificial intelligence and machine learning in the whole data consolidation activity? Would you like to take that?
Yeah, I can definitely say something about that. So I think artificial intelligence has certainly a role to play within consolidation. And there are a few things that can help with that. I just to name one, there's recommender systems, we call it. You know them all from Netflix, for example, or any kind of streaming service. You immediately get a kind of recommendation proposed to you depending on your basically personal treats. And the same thing we basically could apply with consolidation. For example, think about reconciliation, but depending on your past historic linking, for example, to intercompany contracts with each other, maybe in the future your system can learn from that and basically already propose that as a reconciliation candidate to make your life more easier and basically matching and taking off those flags.
Well, interesting, Fred. Thanks for that. And in fact, there is another question, and there are two different questions. I'm going to combine them. So one is, how do we deal with frequent changes in regulatory reporting requirements? And there's another question here that says, well, if there are differences in and opportunities arising from converging standards, how do we deal with those convergence, right? So it's basically about different regulatory requirements and finding common ways of getting them converged. Would you have a view on that, Peter or Fred?
Yes, of course. Thank you. Yeah, how can we address frequent changes in regulatory reporting? You will see in Wolters Kluwer we have certain systems with regulatory update services. So we have a strong development team following up on these regulatory changes. So if you have an integrated solution which covers your finance, risk, and regulatory, you get an update service where you get really regular updates. For our development team is following up the regulatory updates, and this is a kind of service you buy with the product, which comes with the license. And there you have in the maintenance a certain update service. So we're following this up for you. Of course, you need, to get acquainted yourself with the rules. We also give an update, explain you what has been changed and involved. So for that reason, we actually have systems, and we're following up closely because there is regulatory change in every jurisdiction and every local, but also bigger authorities like the European Banking Authority.
Interesting. I mean, that brings me to a very similar but related question. So, is there a single system that can fulfill budgeting, forecasting, and reporting requirements for a tier 2 or 3 bank? Fred, that's what we're here for.
Yeah, that's a very good question. What I can say is that you have actually two approaches to this, right? So you see, obviously, the more, let's say, traditional way of thinking is we need one single solution to take care of everything. And that's what we call typically a monolith. And what basically happens is you have a system and you build on top of that system more functionality. Now, will any kind of solution take care of everything? Forget it. Whatever you're being promised, it's not possible. And I will tell you why it's not possible. Because you have a standard, right? You have a standard solution, and then you have parts of the organization which are typical for that organization only. So you need to take that into account as well. So you will always be ending up a combination of your, let's say, your personal flavors and some of the standards. So that's something that you definitely need to take into account. I think the other part, which is what you often see, is that more and more, let's say, digital banks and challenger banks are moving to what we call an open API architecture, where they basically simply accept that multiple solutions work together, basically to realize the organization goals. And that's another way of approaching that. And that means that everybody has strict responsibilities instead of having one single solution for that.
You just
now,
answered
both,
the question that
yeah.
someone has asked, how can neobanks utilize financial reporting system? And you just answered that. Thanks for that, Fred. Maybe I'll turn back to you again, Peter. And there is a question maybe from John Christoph that says, would you rate various complexity. How would you rate the complexity levels across jurisdictions in the EU? You have a view on that?
If I fully understand the question is how would we rate the complexity? So yeah, you have certain jurisdictions in Europe, and you have your local regulator, but this is driven by the European Banking Authority. So even people from the ECB are sitting with their local regulator. So the complexity is pushed down from the European Banking Authority and the ECB towards the national regulator. So what we see is an increasing demand on reporting. For example, on the question also for post-COVID-19, for collecting data, we see that there is specific reports. It's 3 reports, and European Banking Authority has imposed 3 reports for COVID-19 with specific default statuses. And we're, with our regulatory update service, we are investigating and we are enhancing our data layer and our data model for it to cater with this complexity and with the different levels of complexity, because you could have a local gap next to an IFRS gap or a US gap even for your entity. And for this, we can run this in our systems with financial reporting next to each other and cope with these in parallel.
I'm sure Pankaj Chawla, who asked that question, is very happy to hear the answer of yours. Maybe I'll turn back to you, Ganesh, and there is a question about Middle East here. So how are banks preparing for the FRTB, the funding trading book? And is there an impact you see on financial services?
This depends on the trading book of individual banks. If a bank has a large trading book, then it becomes complex. And then it also requires investments into systems to take care of it and integrate that into the mainstream financial regulatory reporting thing. It depends on the bank to bank, I would say. In our case, specific to our case, we do not have much trading book to worry about this piece. Yeah.
Thank you. I think we have run out of time, so I'm going to ask just one last question. And, the other people who actually want to ask us, you're more than welcome to write to us, and we will make sure we get those responded to you. So if I can turn to you, Fred, and the last question for the day, what are the ways in which banks can reduce their compliance cost?
Well, there's several ways to reduce compliance costs. So one of the ways is to basically follow expertise on the end of the reporting side. And I think Peter already neatly described that. So there are organizations like us who basically take care of some of the aspects by following up on regulations and making sure that the automatic transmission, the allocation of that data already happens. Now, there are a few things that you can do as an organization. Again, we come back to what we started with, it's data, right? So make sure that you not only are able to consolidate data in an easy way for finance and risk, but also make sure that there's clear ownership. And I think that's a very important statement, where you basically say, it's in our data lake, it's still the credit risk people who are responsible for that. And this is the person who I can go to when I see problems with that data. And if you have that, let's say, holistic view of data in combination with ownership, I think you already get a long way.
Well, it's all about consolidation at the end of the day and having the right ownership, right?
Right.
I'm sure that was a very useful response to the gentleman who asked the question. If I may thank each one of you for a very, very interesting, valuable, insightful discussion. I think we went beyond just the context of consolidation and reporting. It also talked about, as they say, the bold new future for the types of change. So with that, I wish everybody a very good evening, and thank you once again.